All right, welcome to OK Computer. I am Dan Nathan. I am joined, I say this every time, by my landlord. This would be Trevor Marshall. He is the co-founder and CTO of Current. Welcome back, Trevor.
Thank you again.
All right, you and I, again, we have so much to talk about. I love having a CTO in my presence here because listen, you've forgotten more about tech than I may ever know. But through the lens of the public markets, I think about these things a lot. I think about the interrelation. I think about how investors perceive it on a real-time basis, and then really how they think about it going forward, what's going to play out and the like. So you and I are going to spend a bunch of time on generative AI and what's going on right now. It seems like there's a slight disconnect in the public markets at this moment. And maybe I keep seeing headlines about valuations in the private markets skipping up. I want to hear what's going on in FinTech, but also maybe how you guys are thinking about generative AI. You and I have had that conversation a few times. And here's one for OK Computer listeners. We're going to go over the yen carry trade. And my main man is going to break it down for us because in his past life, he was an FX trader at a large bank. So we're going to do that. So we got a lot to cover here. Let's start with Gen AI. All right. So what's happened in the last, let's call it month or so, we just got done with Q2 earnings season. We have not gotten to Nvidia's earnings, but we've gotten to many of their customers. So Nvidia reports, I think on August 28th, and everybody's waiting for that because 40%, nearly 50% of their sales come from Google, Microsoft, Amazon, and Meta. So large customer concentration. We know that there's a lot of news in Nvidia right now. There's some government, investigations of monopolistic, practices. They just pushed out their next iteration of their high-end GPU. That would be Blackwell. So let's talk about what's going on because these stocks have been in a little bit of a downdraft. At one point yesterday, that was Monday, August 5th, Nvidia just got killed. It was down 14% in the opening. Now, you look at the stock market a little bit, you recognize the fact for like a nearly $3 trillion market cap company to be down like that, big stuff. So let's talk about what you're seeing and how the markets are perceiving some of these large players. They're the hyperscalers, and then they're the ones providing the chips.
Yeah, these moves definitely feel more like market dynamics than anything underlying.
So but concentration, you think?
Yeah, concentration, or you already brought it up, but like what's happening with the rates in Japan, actually being probably a huge tsunami type of event across things like Nvidia, things like crypto.
Yeah. All right, let's talk about that because Guy Adami, my partner here, has actually mentioned that of late. So if you think about the yen carry trade, break that down for us, and then we can talk about how that money has moved into higher yielding, right? Yep. It's sort of assets. And you think that's what happened here over the last couple years or so.
And big credit to my co-founder, Stu, who's basically been my macro mentor my whole career. He's, hired me at Morgan Stanley, 16 years on Wall Street before we started Current together.
He's that old?
Well, maybe I shouldn't
have said that. You can't tell under the beard.
Yeah, exactly.
I mean?
The beard helps a lot. Yeah. But the short story is, it's been very inexpensive to borrow yen. And you get better rates in other places. So you borrow in yen, you put it into risk assets around the world. And that's driven a lot, you could argue, of the market inflation. And high risk assets like crypto are no exception to that. And high flying equities like Nvidia are no exception to that. So as they come out and start to hike rates, those trades stop making sense. Even just like the basic one.
Are you a Talking Heads fan? Stop. It was a great live album. I'm just saying. And there was also a song that makes some sense about what just happened. Psycho Killer. There you go. Yeah. Right. All right. Sorry about that.
I mean, look, they're definitely marching to the beat of their own drum. They're doing their own thing. But it's having pretty big implications, and it's not a place that most people who follow crypto are usually watching. There's other headwinds going into crypto right now. I think in particular, some of, there's government sales, there's Mt. Gox distributions. There's a lot of
Well, crypto seemed to be very correlated to these high end or these mega cap tech stocks. Is that something that you expected? I know you've watched crypto for 14 years or something like that.
Yeah, I mean, a lot of the people who trade Nvidia. They trade it, as in they're watching it day to day. They're looking at Bitcoin charts, they're looking at Ethereum charts. It's kind of the same super retail to hedge fund, people who are generally driving the near term price action on that stuff. Nvidia at this point is sort of a different story, just given how huge it is and the types of dynamics with like index rebalancing and sort of like things that are it's out of control.
It's gone
of
from
itself.
like a few $100 billion in market cap to over $3 trillion. At one point, it passed, I think, Apple in market cap. When you think about that, that's absolutely crazy. I just want to put one point about the crypto. When you think about Bitcoin and Ethereum, they're $1.5 trillion in market cap. You know what I mean? So they're like, like half of an Apple or half of a Microsoft or whatever. So it's become a reasonable asset class, but it's just like there's so few people that can actually trade it as a macro asset, and there's so much of it locked up, right? So it trades, would you say, on a small float?
My God. Yeah. I mean, even now, with all the development that there's been in sort of like cross-pollinating liquidity pools for crypto, where you've got exchanges like Coinbase, who's at this point doing a ton of their business and just aggregating liquidity across other venues, for the ETF
and they've become a huge prime broker too, right?
Exactly.
I have friends who run crypto funds, and they are all like Coinbase is like the thing.
Yeah, absolutely. They've nailed this transition into sort of the more enterprise platform. Liquidity is still super thin, and especially when you get down into some of the less traded coins. I mean, like even someone who has a few $100,000 worth of something will move a market, which is, you can't do that in pretty much any stock that's available for retail. So yeah, those are super dominated by like the similar players, and that's why you see these correlations.
Did you see, so with the carry trade, like also, VC capital like kind of blew up in the last few years. And part of it is like, and it kind of fits that narrative in a way. If you're looking for the highest yielding assets, now granted, you have to wait much longer. You know what I mean? When you're a VC, you gotta, generally if you're an LP, you have to wait 5, 7, 10 years, right, to get a return on
I think
like that.
It's very likely that there's going to be similar downstream effects of what's happening in Japan there, but for the most part, a lot of that was more of what's the hurdle rate of the risk, and that's going to go more towards U.S. rates than anything else. So if rates are super low in the U.S., then you're going to take more risk to try to make your 4 or 5%. And when rates go up, what's the hurdle rate on the incremental risk that you need to take? If 1 out of every 10 of these things pays off and you have to make a lot of bets, maybe reallocation towards fixed income that's more predictable makes more sense in that. And so that's why you see like right now, like way more activity in sort of more traditional private equity funds versus venture capital with the much longer duration. And the trend that we've seen in venture capital is to extend the duration, because when you look at the yield curve, people assume that rates aren't going to stay where they are forever. And so if you have a super long duration with way more, and this is what this translates to very tactically, is investing in earlier life cycle parts of the company. So seed, Series A, that there's a lot more activity in venture there. Because you don't have to worry about, I need to do like a 2x on this to get my hurdle rate over the next 3 years, which is sort of the later stage.
Right. And again, the IPO, like the exit landscape has not particularly been great. Yeah.
Exactly. And so the recycling that you would expect or want. So there's lots of dynamics that play into that. I'm sure there will be these downstream from like dollar yen effectively.
As an FX trader, though, you've probably seen an unwind of this carry trade. It's probably happened a couple times, you know what I mean, over your career or so. I mean, the reason why this all happened so fast was last week, the Fed at their meeting indicated that they were going to be cutting rates basically sooner or later, which a lot of people expected. But the Bank of Japan raised rates higher than expected. So that differential kind of got blown out. And so a lot of folks have to unwind, to your point about a lot of the stuff they've been buying based on the borrowing of the lower yielding yen. Okay, so let's go back to some of these names, because one of the things that I've found pretty astounding is that, we're kind of coming up on the 2-year anniversary of ChatGPT. That's OpenAI's large language model, all right? And it really caught a lot of folks by storm. I know that you were looking at some of these models, for a whole host of reasons. You probably found them intellectually interesting from a consumer standpoint. You've been tracking machine learning for a long time. This is an evolution of that. And then thinking about for your own business, how you might use these tools, right, to kind of, like advance productivity and do a bunch of things that you probably, hadn't dreamed of maybe 5 years ago. So let's talk a little bit about what this has meant to you as building a business in FinTech. Has it turned things upside down the way you think of it? And I just want an example, like we're talking about companies looking to go public as an exit. Klarna, obviously, which is a buy now, pay later. There was earlier in the year, and I think you and I talked about it. They talked about using, some of these models to kind of, basically cut a bunch of jobs for like customer service positions, that sort of thing, right? And maybe they're just kind of cleaning things up, getting costs down before the IPO. And so how are you thinking about this as a business, as a builder, and how do you think it's going to affect the enterprise? Because one of the things, the jury's still out on the consumer standpoint, how they're using these models.
Yeah, I think so. When we first talked about it, probably about a year ago, maybe probably a bit more.
Yeah, I think right after it came out.
Yeah, so nearly 2 years. It'll be 2 years in November. I think I said at the time that the most interesting use case would be customer service. We've deployed a solution in that space. We're seeing 40 to 50-ish% deflection, which is basically like how much a customer reaches out to you, what percentage of that goes to a human, and what percentage stays captured, sort of within a bot, a back and forth. And
what's some of the feedback you get of the bots? Because, for a long time, they're not smart. When you get pushed over them, on a call from an airline, some people get frustrated.
There's still more to read into it, but what you would call like the declarative version of this, which is like you follow a bunch of rules. Like if the customer asks about, a dispute, you give this response. Right. The generative version of that we're using now performs much better from a customer satisfaction and from a containment perspective, like keeping that contained within the bot. So it's definitely it is a good change. We've rolled forward with that. There's things to do and optimize and tune to make it even better. But that's been still the main area that we've seen advantages. I think some of the second order advantages we're starting to see is that we use a lot of machine learning, not LLMs, but machine learning, and the cost of machine learning has come down. So like training our own models on our own output data sets and building predictive live inferenceable models, that's come down because the cost of compute is starting to come down. And this is like one of the benefits of the flood of GPUs into the market and sort of like the flood of chips into the market.
So let's take a step back on that. So you're basically using Google Cloud, right? And in a lot of these models, you're basically paying for that compute, right? And so walk us through that. Like when you started using some of these models, how expensive was it relative to how it is now? Let's call it, 18 months later or something like that, because they were probably pretty capacity constrained, back then, and then the demand just shot up over the last year or so.
Yeah, there's a couple of components to I would say overall, like doing the same operation. And basically what we're doing is let's take an outcome, like something that we've been really successful at is when a user logs in, we make a prediction. How likely is this to be an account takeover? So this is something that's really common on financial apps. I hit you up on Instagram saying I'm current and you've won $1 million and I just sent you a code, just send me that code.
What are you, Mr. Beast or something like that? What's going on
People
here?
Pretending to be Mr. Beast, yeah. So that kind of stuff is extremely common across everyone. Like talk to anyone in FinTech, ATOs, account takeovers are one of the biggest problems. And we developed a model that taking in a relatively small number of signals, like less than 50 signals based on device, history, things like that, we're able to predict with extremely high precision that this is in fact like a bad session or a bad
So this
account.
used to be very manual. It used to be a person kind of making these
it was never manual, but the models were never that good.
Okay,
and so basically what we do is we take that output. We have a big training set of like, these are things that we recognize as compromise and we can then train a model. And that's what we're doing is we're taking very discrete output. Like these are the things that we're looking for. Here's everything that's existed. And then when I give you net new signal, inference for me, hey, is this an ATO or not? And we've been able to reduce our ATOs by over 90% from the latest version of our model release. And so that workflow we've repeated in 5 or 6 big areas and in a ton of other like smaller areas in terms of risk and things like that. These are not LLMs, but they are using Google's Vertex AI product, which does also power and do tuning on top of LLMs. And I think most likely there's definitely like a compute decrease. Like we've seen our costs go down 20 to 40%, something like that. So just there's like raw compute, how much time and the cost of training has decreased for us. But there's also sort of this incentive at play, which is Google wants to be at the center of the center of like the machine learning and in particular Gen AI workflows. And so I suspect that some of that pricing improvement is also their competitiveness of saying, hey, well, maybe their costs, maybe they're decreasing their margins to pick up market share. That's sort of invisible to us. We just see what we pay.
So AWS is number one in market share. Microsoft Azure is number two, right? And Google Cloud is number three. So you're talking about basically competing on price to gain market share. Do you guys use like some models on AWS, and how difficult is that to do? If you want to use some on Azure, because let's say Azure might have the best resale opportunity for like, let's say OpenAI's technology or something like that.
It's actually it's more product dependent, which is to say that the paradigms and the way that you work with Vertex AI is extremely approachable to developers. There isn't quite the same level of maturity that we've seen. We've been working with Google for a long time, and so our team is super comfortable with it. It's more product based than it is like, hey, just throw this workload somewhere else. So I think like still Google is the best cloud platform for developers. Like I've been saying that for a while. They don't have the widest set of products, but the ones that they do are really, really good. Things like PubSub, Dataflow, Vertex AI, BigQuery. A lot of these actually don't even have very strong product correlates on the other cloud platforms. So yeah, I mean, I think that's the bigger reason why I think they're sort of pushing hard.
It's funny because the market
it's not competing as much on price, more on a product, and then price is part of that.
Well, it's funny, when you and I started talking about this maybe a year and a half ago, I think you remain, based on your own experience, also, pretty positive on what Google was building around GCP and everything like that. The market felt a little different about that, right? For a while, Microsoft was accruing a great deal of the market cap value. Amazon, played some catch up, and then Google finally joined the party like 6 months ago and actually kind of outperformed those others. And so I just want to kind of hit on one thing though, as we, okay, so there's capacity constraints. There was a lot of demand, right? So for this compute, do you think there's a good chance? And I've read some pretty smart folks about this who've been around for different cycles. They kind of saw what happened with the internet and the overbuild there. No one believes there's an overbuild when there's so much demand for these sorts of technologies when they're really new. We saw the same thing into kind of the mobile broadband, sort of cloud thing with SaaS and everything like that. Let's call that in the latter half of the 2000s, right? So this is our next thing, right? In 2020. So help me think about the potential for, these large language models where those three companies have spent tons of billions, maybe hundreds of billions of dollars kind of building out, buying the chips, building the servers, building the data centers, right? And so what do you think the potential for the commoditization of these models and then the overcapacity in the not so distant future?
I do think, this time it's different. I don't know. This is probably just...
You didn't just say that. You did that. If you're listening to this, he did it in air quotes. If you're watching,
exactly.
Okay.
Exactly. Like as in, maybe I'm wrong, but I do think that the shape of this is different. Like with broadband, for example, you need it to use it, right? It's not like a startup cost. It's like if you're using bandwidth, you're using bandwidth, and that increases over time. With a lot of these models, you train them, and then the inferences are extremely cheap and small. And so it will mostly come down to what are the next legs of development in the model training side that are required. And that's where, like, the shape of it is you train, you bear all that cost up front, and then you monetize it through inferences that are really cheap, and you don't need that capacity. The real question is, well, what do we need to keep pushing? And I'm sure people who are working in the space say, well, there's decades of roadmap ahead. I'm just not familiar enough about where we go next to be able to say, yeah, of course, we're always going to need 2x the number of chips to train on.
All right, help me understand something. Okay, so if Nvidia has this hopper, okay, it's H100, and everybody needed them, okay, to kind of train these models, and then if you're telling me that the inference phase is much cheaper, right, then why do we need Nvidia's Blackwell chip? You know what I mean? That is supposed to be so much more powerful, but it's going to be probably just as expensive as the hopper. And then Rubin is coming along in 2026 because Jensen Huang, the CEO of Nvidia, he's mapped out this product roadmap, right? And those are that's gonna be so much more, you know what I mean? Like, that much faster. So it seems to be defying Moore's law in a way, right? So let's talk about that, right? Because it used to be every 2 years you would double performance, but then the cost would go down, right? And this seems to be going the opposite way a little bit. And there was a quote that Jensen Huang had is like, what we're doing defies physics and stuff like that. That was back in March, and all of it just seems like a bunch of mumbo jumbo. You know what I mean? Like, so explain this to me.
Yeah, I think the first thing I think of is like in 2009 to 2010, you had the first ASIC chips developed for Bitcoin mining, and it was an explosion of like, well, why do we need this much hash rate? And the thing that's different for the incentives behind that basically were that, well, you've got this, deflationary system, which is the block reward of Bitcoin decreases over time. So the faster you get as much computing power as possible, the faster you get your Bitcoin. Like there was a real like urgency incentive in place there. It kind of links to what you were saying before, but having a 90% market share may be the pricing power. Like that could just be the urgency on its own, which is to say if Nvidia is the pipeline, there doesn't need to be the same sort of external urgency factor of like, hey, we actually need this faster, better now, because there isn't really that much competition.
Right. And so what's interesting to me about this is off of the October lows, okay, in 2023, AMD rallied, 150%. It joined the party like in a way where, their CEO kept on coming out and talking about the TAM and how big it's going to get. And they were talking up some of their products that were going to be competitive to Nvidia. And of course, they were going to compete in price, okay? From the early March high, in AMD, the stock is down 40%. The product's never materialized, okay? But it's not just AMD. So that would have been competitive to Micron. We know that Microsoft, so some of the biggest customers, okay, of Nvidia have said that they're designing their own chips, right? So 90% market share Nvidia has, but Microsoft, Google, Amazon all rushing to design their own chips, right? And so then I think about, okay, Micron joined the party because, these things need a lot of memory, right? And Micron is, the market, share leader there. Well, Micron is down 40% in the last 2 months. Dell, that builds the servers, okay, that go in the data centers, is down 40% in the last few months. Okay, so when I think about this, Supermicro, which is also a server provider, down 50% in the last 5 or 6 months. So parts of this trade in the public markets are coming unwound. All right, but Nvidia, which is down, it was down 30-some% its lows on Monday, and it's bounced back a little bit, but it's down 25%. Right, so I don't know how it is, but for some reason, public market investors are souring on this trade a little bit, and Nvidia is kind of the last man standing, if you will.
Yeah, I mean, it could be just a power law. It's the biggest one. It's got the most attention. It's got, when people think of Gen AI, they think of Nvidia, and they don't necessarily think of Micron, and they don't.
So just, back in 2000, when people thought of the internet build out, they thought of Cisco, Nortel, and Lucent. All the three of those stocks lost 85% of their value from the highs to the lows, okay? Cisco was a profitable company, Amazon, with the promise of e-commerce, lost 85% of its value from its highs in 2000. So I guess my point is, you could tell me we're at the infancy of generative AI and how it's going to infect every industry. You know what I mean? It's going to be a really big deflationary force and this and that, whatever. And I believe that, Nvidia might be the first $5 trillion market cap company. It might be the first $10 trillion, but not before there's a massive correction, in my opinion.
Yeah.
You know what I mean? All right, so let's just talk about, I mean, one of the reasons why Microsoft, Amazon, and Google have appreciated, because again, they have all of these applications, if you will, for customers to come and use their, obviously compute, but then also license these models, right? To kind of do the training and like here. So are you more optimistic about what those companies are going to be able to do, right? Because they've built their own models or they're licensing them, that sort of thing. Because like market share, like the TAM's just going to get bigger, right, over time. So I guess the issue might be that if pricing just comes down, right, because CapEx slows because the lack of monetization that a bunch of customers are feeling about this, and they're like, well, we're not going to really pay that much more for these services until we can figure out what our model is to monetize.
Yeah, because the cost of inference is so low compared to training costs. I think. And it's sort of like a counter thought to what you're saying, which is, what is the role of something like OpenAI in this reality? And to me, over time, even though they are sort of the ones who are pushing forward, the progress of training, and they have sort of they're moving into this multimodal world, and what comes into 5.0 or whatever, like this whole roadmap. Over time, they need to become embedded within a Microsoft or embedded within a distribution partner effectively, because there's not that many people who are using it directly. I mean, certainly like in terms of the operationalization of bringing these models as a product company, you're probably going to source that from your cloud provider more than another provider. And then it's probably going to be pulled into more direct applications, like something like, that we would use would be like a Datadog or a Zendesk, or some other platform might pull that functionality in separately. I think the ones that ultimately win in the sort of inference economy, once you're beyond training, or you've taken the economics away from that, is generally the people who are leveraging it as product companies the most. So, like, we've seen improvements. I would say we haven't seen like step function changes in any of the software that we use. Everyone's like integrating it. You can go into like probably half the tools that we use. There's a little like, hey, ask us, Gen AI section. So it's like it's making its way into SaaS, but it doesn't really do that much for us. Like it hasn't changed any of our workflows fundamentally. Like I said earlier, like the only thing that it has legitimately started to change, and it's not quite a step function, but it's on its way to a step function, is improvements and containment for our chat bot. That's about it still.
Are you still, though, very optimistic about what might come in a year, 2, 3, that sort of thing?
I don't think I've ever been like that optimistic.
Really?
Yeah. I mean, I've been like excited about, hey, this seems really cool. It's magical. Like when the thing that first caught my eye about OpenAI is this concept of tokens, and like the way that they would break down language to a monetizable little chunk, which then they charged you for, was to me like a really interesting engineering thing. And just a completely different way to think about not quite computing, but like the business logic behind computing.
It's funny, and you might have a much better sense than I do. I have a feeling that OpenAI is going to be an absolute dumpster fire. I mean, I really do. They've lost. It's been a massive drain. It's been a massive brain drain. There's so many people who have left that company and started some really exciting sort of competitors, or gone in different directions. And there's billions and billions of dollars that have been allocated or invested in those startups. And it just seems like everybody other than Microsoft might have a lot of incentives, right, to kind of, I don't know, move away from OpenAI's technology. Does that make some sense?
No, absolutely. I think when we first chatted, I said it'll be the cloud providers ultimately, right? Because like and it's because it's the distribution, and how do you turn like this thing, which is a model, into operations for a product, and so there's a lot of instrumentation that's required. And the cloud providers are in the best position to provide that instrumentation and probably do it at the biggest scale. Whereas sort of the SaaS companies, like for example, Microsoft is integrating OpenAI everywhere into your PowerPoint, into your Microsoft Word, whatever. Those types of product companies are probably the ones who will do it at the highest margin, because as an end user, you don't have to think about this stuff. But the highest scale will be most likely at the cloud providers.
So Microsoft reported, I want to say a couple of weeks ago, and there's a couple of things that I just found really shocking in that report. And one of them was that they said they have 10,000 users testing Copilot, I think on Microsoft 365. It wasn't 10,000 customers. It was 10,000 users. And that's shocking to me. And I also read something, it was in the information about a month ago, maybe we'll put it in the show notes. It was an interview, I think with either the CTO or the CPO at Chevron. Okay, so this is a large integrated oil company. And they were talking about just, they're testing these products and they just don't feel that they're particularly interesting right now. And they had 200 folks giving, and I'm like, giving feedback and the like. And I'm like, oh my goodness, like there's been hundreds of billions of dollars in capital spent to do everything, to create all this stuff and create these data centers and do all this stuff. But there really is no monetization. The fact that we're talking about, a few thousand or 10,000, people using this stuff, it doesn't make me optimistic anytime soon these companies are going to be able to monetize this.
From a business perspective, the technology is not precise by nature. So, you're not going to get deterministic out. Like basically when you're building a system of systems, you want deterministic output. You want structurally where this is best is sort of at the very edge, whether that's talking to a customer or producing a piece of art or, at the very edge of communication transmission, embedding this probabilistic engine deeper means that you're introducing entropy and uncertainty into a system. And so when you're thinking about, well, what are the building blocks? Like a server is a building block, Unix, is a building block. There's these very robust things that you build businesses on top of. We haven't yet seen how to integrate a probabilistic building block sort of into products. Like all these SaaS companies, it's like it's the search on top of, hey, look, let's get some insights. It's the very edge. It's the fuzzy bit of communication.
Well, what's interesting when you mentioned SaaS. So again, the market as a report card, at least the public market. So on the year, Salesforce is down 8%. Adobe is down 13%. Workday is down 23%. Twilio is down 21%. I could keep going. Klaviyo is down 17%. Snowflake is down 43%. Okay. And I could go on here. For some reason, public market investors have said to SaaS or, in a Snowflake, it's like data organization and stuff like that, no mas, no interest, you know what I mean? And when you think about Microsoft and Amazon and Google and Nvidia and Apple, and I want to talk about Apple in a second too, they've accrued trillions of dollars in market cap. Just think of that over the last, year and a half or so. So what's going on with SaaS?
SaaS in particular, it's like a dangerous thing in a down market for tech because the users of SaaS are companies like Current. And for the last 2 years, really, one of the things I've been focusing on is spending less on software. Right. And that's the same thing that's at every startup and every, larger than startup type of company that uses software. And just, there's a reality of they don't sell to, people on the street. They sell to people who are way more focused on price and way more focused on, how do I get this more efficient? And so when it's hard to raise capital in the public or private markets, you want to just look at efficiency. And that's been the story from every sort of peer that I have in the private sort of tech, FinTech, whatever space. It's efficiency. We're everyone's increasing their margins by efficiency. So to me, that's just, you're seeing a second order onto SaaS, which is why I don't want to renew this contract. I don't want to renew that contract. Let's make sure that we have something that's sufficient that we can run ourselves. That's just been the trend for the last 2 years.
Would you expect a bunch of M&A in SaaS to try to find some kind of new growth areas?
Yeah. I mean, I think unfortunately, one of the biggest levers that's available is just people who have huge dominance and lock-in. Zendesk is a great example of that. Private equity came in on that, and they just have massive market share. So you can just turn the dial on monetization.
Well, it's funny. Before rates started going up, private equity was gobbling up software companies, right? About a year and a half ago or something like that. So I think that's pretty interesting. All right, I want to get to Apple really quickly. I know you're a green message guy, aren't you? Or
what is that?
You know what that is. You know what that is. You're that guy in the chat, right?
I do. not have a
so you're
Apple
not
phone.
that focused on Apple, but June 10th they had this developers conference. They have it every year. They announce some changes to iOS, and most of them are very evolutionary, right? Most of them are like, look at this new way to look at your calendar, or what, you know what I mean? It's a bunch of crap, and they try to like overhype it and this and that. And then there's always talk about upgrade cycles. There's like the average age of an iPhone is 3.5 years, something like that, right? Whatever. And their phones are just evolutionary. They have brighter screens. They might have a little better battery, a little faster processor. So what they rolled out, and I think it was like a genius little trick. So Apple Intelligence, right? And at the time, there was rumors that they were going to license, OpenAI and possibly, Google's Gemini or whatever. And they did OpenAI, but then they said, we're probably going to do the same with Gemini, and they're not paying anything for it, which I thought was really interesting, right? So But the services that they have, it's going to be on device, a certain amount of it, and then they're going to use, OpenAI to do other things across their operating system. Well, the stock, which has been a huge laggard, until June, because they didn't actually have any strategy how they were going to use Gen I and a consumer product, it went crazy. It literally went up in 2 days, 10%. This is a $3 trillion market cap company, right? And then it continued to go up over the next month. So Mark Gurman at Bloomberg came out and said, it's not going to be that great, and, doing some of the beta testing. And then they actually said they're going to push out, the release of some of these things. So talk to me about that strategy for a company that has like an installed base of like 2 billion or something like that devices, iOS devices. That's obviously iPhone, iPads, and that stuff. Like, how does that make you as a consumer think about this? Because I know that your Android already had, Samsung already had some an AI phone or something.
Yeah, I buy it because Apple has distribution. And this is the point I was making earlier, which is like Gen AI works really well at the fuzzy edge of communication, and like what app it suggests to you, insights it can provide. That's a perfect use case. So I buy that. Like that makes sense to me. Like,
would
why
you pay so let's just say the ASP, of an iPhone is like $900. And let's say with all this stuff on device, it's going to be because they're going to have a much more expensive processor, more memory, right? All this sort of stuff. Would you pay $1,300 for that phone to have those sorts of services?
Yeah. I mean, if you're, again, as an Android user who pays like $600, $700 at most for a phone, to me, like once you've broken this barrier in terms of like, this is more than a month rent for most people, it's probably you can charge another $200. Like, why not? I think.
And the way the carriers are doing it now.
Yeah, exactly. Like, there's deals. There's all of these things, and there's planned obsolescence. So 2 years in, you're going to cycle it anyway. I think it helps justify higher prices of hardware. I think I actually think that it's the best use case I can see right now. Sort of this last mile to a consumer. How do you shape things? Like literally, I mean, I have a Pixel, and the Android that's on Pixel is very clean, and they've since really like the last couple of years, they've been doing like amazing app suggestions, like amazing. Like almost freaky. Like I'll swipe up to go to an app and it's there, and I haven't opened that thing in like a while, and I'm like, what is happening? It's.
Do you have a new Android? The Pixel's Google.
I have like the Pixel 7.
Yeah,
and
it's
not
doing
newest.
That. But it doesn't have Gemini integrated, like just the software.
It does now. Yeah.
Okay.
I'm like
in the operating system.
I don't know at what level. It seems to be embedded in actually just the Google apps. Not
do you think though
Android.
that Google so Pixel market share is probably single digits of like high end smartphones?
That's
right?
charitable.
Yeah, no, it might be. But do you think that they have the potential like to gain share if their phones are cheaper and it's integrated and they've already actually made the investment in these?
Honestly, if they fixed the green text thing, it's so dumb.
Well, no, Apple said they're gonna. I mean, so
consumer things are dumb usually. If they fix that, I think Pixel gets more popular. It's been well known by like most consumers that Pixel has the best camera, and the reason it has the best camera, the hardware is very good, but it's actually Google's software on there, on device software, makes it look incredible. Like whenever I'm taking a picture, if I look at an iPhone versus, it's always better. So I think like if they can fix the green text problem, it honestly probably makes a huge difference to a lot of people.
But just to put a bow on this, like Apple, you like their strategy.
I think that's smart.
But you think it's going to take probably a couple years for like most consumers, A, to upgrade, and B, really understand how to use this tech. Because
I think it'll be faster.
Really?
Way faster. I think it's going to be intuitive. I think a lot of this stuff, like Apple's really good at making things like this intuitive. And I think
it takes them usually a couple years on the software front.
Yeah, but I don't know. Some of the stuff, it's like they've done it before. They're taking ideas from Android, and it's going to be faster. I think that makes a lot of sense. I think the 10% rally maybe is a little much, but that's the right direction. That's where they should be deploying it.
All right, let's talk lastly about FinTech in general. Stu comes on the pods and he's been on Fast Money, and we always find his take on what the consumer, and especially the consumer that you guys serve. We've seen unemployment tick up. It was at a 50-year low at 3.6%. It's at 4.5%. I know that you guys are building this credit product over the last year or so. I just, from my conversations, it sounds like that's doing pretty well, right? It was a natural extension of some of the stuff that you were doing. Put some framework about some of the things that you're seeing in the space and how you think it's going in general. In a high rate environment, and we're expected to see rates come down. It used to be about 6 to 9 months ago, rates were going to come down because the Fed did what they needed to do on inflation and kind of slowing the economy a bit. Now, over the last week or so, it feels like that they are going to have to cut interest rates because the economy is slowing. So how does that affect your consumer base and really the uptake of your products?
Yeah, I mean, the main thing that we care about is jobs.
Because you guys do the paycheck advance, we do direct deposit.
Everything we do is linked to getting paid by an employer. Because generally we're serving people who don't have access to credit, where you can look at a credit history and you can be, valued for, the performance you've had. Like, our customers generally are not meeting a lot of those criteria. And so we compensate for that by doing cash flow underwriting, looking at where you're getting paid from, how frequently, all these things. So the biggest macro risk for us is if the economy unwinds is massive job loss, but we don't have employer concentration. It's very broad based. So that's like a scary situation for everyone in that case. I think generally our customers live in a bit of a permanent recession. Like they're a high rate environment just means that they get even less access to reasonable credit because they can't be risk priced sufficiently. So yeah, I mean, look, we are in a good position with the backdrop of things like Chase coming out and saying they're going to start charging monthly accounts.
It makes your offering that much more.
Yeah, exactly. It's sort of like we actually help strengthen bigger banks who are really just frankly losing money on the customers that we end up taking from them. So it's sort of a win-win.
Well, it's interesting. You guys have made this point that you're trying to service the unbanked or the unprofitable client for these large money center banks in a way. And what's interesting is because I use your cards. My kids use them, and it's a really great way for me to keep track of what they're doing. They own crypto in it too. This is something that's interesting to my older daughter who's 21 years old, that sort of thing. It's and so when I look at the actual offering, it feels like a really high-end offering, but it's geared towards, let's say, an aspirational customer.
Oh, for
Does
sure.
that make some sense?
Yeah, the sort of brand attribute would be progress seekers, people who are optimistic about their future, who are willing to put in the work. The design systems we have in place are very much like, we're not telling you what to do, we're giving you the tools to do it. And so people will, create a better financial outcome for themselves.
Well, all right. So we just mentioned Klarna before. It's a buy now, pay later. It's been around for 15 years. It's finally planning to go public. It seems that, a firm in the public markets has not done particularly well. Obviously, competitor in buy now, pay later. What are some new models? What are some new things that you're seeing? Again, Klarna and Affirm are not that innovative. You know what I mean? They just did, that sort of lending online, you know what I mean? In an app sort of environment. I'm just curious, what are some of the things that kind of excite you when you think about the landscape?
I think the biggest thing, and as part of the product that we launched, is earned wage access being the new credit card. Actually, it's effectively replacing, a credit card. When you think about it, is an extremely blunt tool. It is a generally very high rate with maybe not so good limits for, if you don't hit the right box. It's actually an amazing tool, having sort of this open-end revolver. If you've got money and you've got a credit history and good things, it's a very effective tool and a way to manage your cash flow. But if you're not in that bucket, it's problematic. There's debt traps that people get into where they're just paying interest, they're not getting any benefit, and this lasts for years if they want to avoid sort of like a bankruptcy or avoid massive delinquency in their credit score. So there is the earned wage access side of that where you're getting effectively like these no recourse, no mandatory fee products. This is a really good liquidity solution. It's what we launched. It's what others in the space have launched similar products. That is like the biggest trend that we've seen recently. And as there's more and more regulatory clarity about how this thing operates, we're just really excited to be in the space at this time. But that's like honestly the biggest innovation that we've seen is this move away from like low limit, high APR credit cards towards earned wage access.
All right, Trevor, I really appreciate you coming across the office here. It wasn't too much of a commute for you, but kind of breaking down how you guys are using a lot of these technologies, but really getting in the weeds of like the kind of whole chain of these sorts of things. I'm sure our listener is going to be as interested as I was. So thanks for being here.
Absolutely.